this. Picture this. It's a crisp Monday morning in your trading war room. Okay, fine. It's your kitchen table with a laptop propped on a stack of takeout menus. The coffee's brewing, your charts are glowing like a neon sign in Vegas, and you've got that fire in your belly. You've just binge-watched another round of those glossy trading YouTube seminars, the ones where the host, tanned, tie askew, voice like velvet, preaches the gospel of the 1-3 risk-reward ratio. Risk 1, make 3. Win just 25% of the time, and you're richer than Elon on a good day. It sounds like the cheat code to financial freedom. You nod along, scribble notes, and by lunch, you've rejiggered your entire strategy. Stops tighter than a drum, targets stretched to the horizon. You fire off your first live trade on GBPJPY, a classic breakout setup. The market teases you upward, then yawns, reverses, and tags your stop like it's personal. -1R, no sweat. Math says it'll even out. But by Wednesday, you're down 3, staring at a screen that's starting to look like a Rorschach test for your regrets. And that's when the doubt creeps in. Is this really the path to glory? Or am I just the punchline in the market's endless dad joke? Welcome, traders, dreamers, and anyone who's ever sworn off screens after a bad Friday close. Welcome to this deep dive episode on flipping the script on one of trading's most stubborn sacred cows. Inspired by that razor-sharp video breakdown, why 1:1 RR beats 3:1 RR for retail traders, we're spending the next 50 minutes unpacking why the humble 1:1 risk-reward ratio, risk 1 unit, reward 1 unit, isn't just viable. It's often the superior play for us everyday warriors, battling the algos and our own inner saboteurs. We'll myth bust the 1:3 hype. Crunch the numbers until they squeak, dissect the psychological quicksand it creates, share war stories from legends and learners alike, and lay out a battle-tested roadmap to implement 1:1 without feeling like you're settling for decaf. We'll keep the tone real, a sprinkle of wry humor, because trading's absurd enough to laugh at, but mostly straight talk, because your account deserves it. If you're tired of chasing unicorns and ready for a reliable workhorse, pour that second coffee. Hit pause on the Guru Reels, and let's roll. This is Trading Unplugged. Why 1:1 crushes 1:3 for the retail grind. Let's start at the beginning, because myths don't die easy. And the 1:3 risk-reward legend is like that zombie in every horror flick. Keeps shambling back no matter how many times you stake it. It traces its roots to the early days of systematic trading, when quants like Ed Thorpe were turning blackjack edges into market gold. The appeal? Pure, intoxicating math. In a vacuum, emphasis on vacuum, it's elegant. Suppose you're risking $100 per trade, your R or risk unit. A 1:3 setup means your stop loss is $100 away, but your take profit? A juicy $300. To break even over 4 trades, you only need one winner. That $300 covers 3 $100 losses, with pocket lint left over. Scale it. At a 30% win rate, your expectancy, that holy grail metric of average profit per trade, pops positive at 0.2 R. Run the numbers on a spreadsheet, and it sings. $10,000 account, 1% risk per $100, 100 trades a year? You're compounding like a boss, eyeing that beach house by Q4. But here's the first crack in the facade, and it's a doozy. Markets aren't vacuums, they're vacuum cleaners, sucking in your illusions and spitting out drawdowns. That 30% win rate? It's a fairy tale for most setups chasing those distant targets. Why? Because to hit 3R, you're often entering on marginal signals. A decent pullback in a shaky uptrend, or a breakout that's more hope than momentum. The path to 3R is littered with potholes, overhead resistance you forgot about, a surprise NFP print that flips sentiment, or the classic fakeout, where price wicks to your target just to troll you before reversing. Real-world data from platforms like MyFXBook or Edgewonk shows that for retail Forex traders averaging 1:3 ratios, actual win rates hover around 18-22%, Plug that into expectancy. 0.20 multiplied by 3R. 0.80 multiplied by 1R equals 0.6R. Minus 0.8R equals negative 0.2R. Negative. You're not compounding, you're eroding one almost there trade at a time. And oh, the opportunity cost. That's the sneaky thief in this heist. While you're nursing a position that's meandering toward 3R or not, the market's serving up half a dozen 1-to-1 slam dunks you skipped because they didn't fit the big win mold. It's like skipping appetizers at a buffet to save room for the dessert that never arrives. A study from the Journal of Trading, pulling data from 2015 to 2020 across major pairs, found that traders fixated on honest.wa plus ratios missed 45% more high probability setups, leading to 28% lower overall returns than their balanced counterparts. The video nails this. 1:3 isn't wrong, it's just mismatched for mortals. Pros with billion-dollar flow and insider whispers can afford the patience. Us? We're playing with fire on a unicycle. Shift gears to 1-1, and suddenly the game's not about home runs, it's about batting .300 consistently. Risk $100, target $100. Break even at 50% wins. Demanding, sure, but within reach with disciplined entries. At 55% expectancies, 0.1R positive. Modest, but it stacks. Why does it work better? Shorter holds mean less time in the ring with Mr. Market's haymakers. Your stops hit quick if wrong, but if right, you bank fast and redeploy capital. No more let it ride prayers, it's mechanical, like clocking in at a job that actually pays. That same journal study, traders on 1:1 averaged 62% win rates with 12% annualized returns versus 19% wins and 8% for 1:3 chasers. Drawdowns capped at 4 to 6R strings, not the 15R marathons that turn $10 into a sob story. But let's not gloss over the math with platitudes. Time to roll up sleeves and crunch it properly, because numbers are trading's North Star, even when they hurt. Expectancy, remember, is your edge per trade. Win percent multiplied by average. Win-loss percent multiplied by average loss, normalized to R. For 1-3, assume a realistic 22% win rate from backtests on, say, the EUR-USD daily chart using a simple EMA crossover with 3R targets at the next swing high-low. AVG win, 3R. AVG loss, 1R assuming tight stops. Expectancy, 0.22 multiplied by 3 minus 0.78 multiplied by 1 equals 0.66 minus 0.78 equals negative 0.12R. Ouch. Now, factor in slippage, 0.2 pips per side on Forex, and commissions. Drops to 0.18R over 200 trades? That's a 36R bleed, or $3,600 gone on a $10 account. Not hypothetical. That's pulled from anonymized broker data in the video's appendix. Flip to 1 on the same setup, but cap targets at 1R. Say, the 50% fib retracement or a quick momentum stall. Win rate climbs to 58% because you're not waiting for perfection, you're taking what's served. Expectancy, 0.581. 0.42, 1 equals 0.58, 0.42 equals 0.16R. Add slippage, still 0.12R positive. 200 trades, 24R, or $2,400 profit. And here's the compounding magic. At 1% risk, that snowballs faster because you're trading more often. Fewer capital droughts. Run a Monte Carlo sim. Grab Python's NumPy for this at home. 1-3 at 22% wins, yields a 65% chance of drawdown over 10%. 1 at 58%, just 22%. It's not sexy, it's survivable. Survivability is 90% of the game. The rest is just showing up. Psychology, the real boss level. If math is the map, your brain's the gremlin redrawing it mid-journey. Chasing 3 turns every trade into an emotional odyssey. Enter on that promising pin bar. Watch it grind sideways for days. Your inner narrator? It's building any minute now. Then, bam, Reversal candle, stop tagged. The loss isn't just 1R, it's the sunk time. The FOMO on other setups. The whisper that maybe I should have held longer. Q-tilt. Overtrading to recover, widening stops on the next one, or ghosting the markets altogether. Behavioral finance research from Kahneman and Tversky's prospect theory explains it. Losses loom 2.5x larger than gains, but 1.3 amplifies that by stretching the pain window. A 2022 paper in the Review of Financial Studies tracked 1,200 retail accounts. 3 users showed 3.4x higher deviation rates from plans, leading to 41% more blowups. 1. It's therapy in ratio form. Wins come quicker. That dopamine ping every 1.7 trades on average, building a feedback loop of, I got this. Losses? Sharp but shallow, like a paper cut versus a slow bleed. You shrug, journal the setup, and cue the next. Confidence compounds. After 20 greens, you're not questioning entries, you're refining them. The video's trader testimonial rings true. A guy named Mike from the comments section switched. Mid-2023, post a 1.3 induced 25% drawdown. First month on 68% wins, up 4%. Felt like cheating. No more what-if insomnia. It's the tortoise mindset. Slow, steady, but across the finish line while the hares nap in the weeds. To hammer this home, let's stroll through history's Trading Hall of Fame. Because legends didn't get legendary by accident, and their ratios whisper secrets if you listen. Start with Jesse Livermore, the original speculator, whose life was a roller coaster of booms and busts that make crypto winters look like kiddie rides. In his 1907 triumph shorting the Knickerbocker Trust panic, Livermore didn't swing for 1.5 fences. He scalped 1 edges on copper and rails, tight stops below key supports, targets at the next pivot, banking $250,000, about $7 million today in weeks. Why? He knew from bitter experience. His 1901 big win on Northern Pacific chased a 1.4 dream, got margin called mid-run. Lesson etched in his memoir. Cut quick, take what the tape gives. Livermore's edge was pivoting ratios to market mood. 1 in chop, honest .wa in trends, but never forcing the stretch. Retail echo. In volatile 2022 traders mirroring his 1 on VIX spikes averaged 15% returns. 3 chasers flatlined at 2%. Fast forward to Paul Tudor Jones, the macro maestro whose 1987 crash call is trading's equivalent of calling your shot in pool. Jones didn't bet the farm on a prophetic 1.10 short. His Tudor fund layered 1.5 positions. S&P futures entered on channel breakdowns. Stops at 1% account risk, scaled exits at even money when volume faded. Confluence, valuations at 20x earnings, insider selling spikes, spotted the top, but ratios kept him alive through the October 19 bloodbath. Result, 200% YTD, while the Dow plunged 22%. In interviews, Jones demurs, I manage money as if a 12-year-old were trying to take it away. 1 embodies that. Simple, defensible, no heroics. Contrast with 1998's LTCM fiasco. Those brainiacs modeled 1.8 convergence trades on bond spreads, leverage at 28. When Russia nuked the thesis, no quick exits, they doubled down, praying for mean reversion. $4.6 billion vaporized. Funny in retrospect, like watching chess grandmasters play checkers. But the moral? High ratios without high conviction are high-wire acts on net. Ed Sykota, the quiet quant who turned $5,000 into $15 million from 7288, offers another masterclass. His computerized trend systems, not rigid 3 chases, but adaptive filters capping most at 1.5, with pyramids on runners. In the 74 Cocoa boom, he rode a 1 base to 4R total, but only after banking initial targets. Win by not losing was his mantra. Frequent small wins funded the big swings. Psychota's backtests, shared in Market Wizards, showed 1 cores yielding 60% plus adherence versus 35% for stretched plays. Retail traders aping this on commodities today? Platforms like Thinkorswim report 18% CAGR for 1 trend scalps, double the 1-3 variance. Even modern voices chime in. Linda Raschke, the futures phenom, preaches take the money and run in her Street Smarts playbook. 1 on breakouts, scaling if momentum holds. Her 1990s track record? 30% plus annuals, low teens drawdowns. Or consider the anonymous quant blog's post-2020 one from Quantopian's archives, simulated 1 versus 1-3 on SPY options. 1 edged out by 14% over 5 years, with half the stress. These aren't outliers, they're patterns. Pros flex ratios like yoga masters. We mortals need the 1 anchor to stay centered. But theory's cheap. Let's get gritty with the hypothetical deep dive, because nothing cements conviction like walking in someone else's shoes. Meet Alex, a composite of every trader I've swapped war stories with. Mid-30s software dev, $15 prop account, grinding Forex evenings after the kids' bedtime. Alex starts 2024 chasing 1-3 gospel from a $997 course. Setup, 15 min AUD/USD. Enter on RSI, 14 oversold bounces. Stop below, swing low, 20 pips. Target 60 pips at next resistance. Backtest looks golden, 28% wins, 0.05 R expectancy. Live, first month, 12 trades, 2 wins. That second win hits 3R after a Fed tease, plus $450. Euphoria. But the 10 losses? $1,000. Month 2, 15 trades, 3 wins. One grazes 2.5R before reversing on a tariff tweet. The others stop out early. Drawdown, 8%. Alex starts tweaking. Looser stops this time, deviating to 1.5 on strong signals. By Q2 accounts at $12. Tilt in full swing. He skips a clean setup, revenge trades a new straddle, blows 5% in one go. Enter the pivot, July. After a forum rant goes viral, 1-3 is for whales, not minnows. Alex tests 1. Same RSI base, but target at 20 pips. First support flip. Month 1, 18 trades, 11 wins, plus $380 net. No thrill rides, but steady. Losses, quick stings, journaled. False bounce on low volume. Add filter next. Win rate holds 61% through Q3 expectancy 0.14 R. Drawdown maxes 3%. By year end, $15 to $18.2, 21% return. Alex's log. Trading feels sustainable? Like a marathon, not a sprint to burnout. That's the 1 alchemy. Turns grind into groove. Common pitfalls? Oh, they're legion, and dodging them is half the battle. Pitfall 1, but my backtest says 1-3 works. Counter. Backtests lie sweetly, ignoring regime shifts. Test 1-3 on 2018's vol explosion. Win rate tanks to 14%. Solution. Forward walk your sims. Add 0.5 R slippage. Pitfall 2. Boredom blues. 1 feels small. You itch for the rush. Hack. Pyramid 0.5 R on winners hitting 1 R, blending to 1.5 without force. Pitfall 3. Over-optimization. Chasing 70% wins on 1 curve fit city. Aim 55-60% refine with 1 variable quarterly. And the biggie, emotional slippage. That 40% loss streak? Normal variance. Review your 1,000 trade sim, showing it happens 12% of runs. Breathe, stick, thrive. Now the roadmap, your 50-minute payoff, broken into chewable steps for implementation without overwhelm. Step 1. Audit ruthlessly. Pull your last 100 trades or sim if green. Categorize what was real win rate on 1-3. Expectancy. Mark missed 1 ops. Price hit even money post-exit? Tally the bleed. Tools. Excel or trading journal apps like TraderSync. Goal. Quantify the pain. Conviction follows. Step 2. Redesign entries for probability, not payout. Ditch hope signals. Demand confluence. Technical e.g. Pin bar at 200 EMA, volume 1.2x AVG, time, London Open, no news. This baselines your 1 at 55% plus. Backtest on TradingView. Script, a simple MA filter, long if close EMA 20, and RSI 30 target 1R, stop 1R. Iterate till sharp 0.8. Step 3. Mechanical exits, no mercy. Set alerts, TP at 1R. Trail stops only post 0.5R if trending ADX25. Automate if possible. MT5 EAs for Forex. Pro tip, partial at 0.5R. Let half ride to 1.5R on strong movers. Keeps the soul alive without sin. Step 4. Size and scale smart. Start 0.5% risk. $50 and $10. Max 2 trades open. Hit 60% over 50 trades, bump to 1%. Quarterly review. If expectancy dips below 0.1R, tweak entries, not ratios. Step 5. Psyche-proof your process. Daily ritual. 5-min meditation pre-session. Visualize 3-1 cycles. Win, loss, win. Journal triads. Setup conviction, 110 emotion at entry exit. Lesson. Weekly. Adherence, score 90%. Reward yourself. New keyboard, not a yacht. Step 6. Evolve, don't stagnate. 1-1-1's your bootcamp. After 500 trades, test on Estot wall on trend days, e.g. post-earnings gaps. But anchor in balance. Markets shift, so do you, gradually. Variations for flavor. Scalpers. On 5-min crypto, 1 on Bollinger Squeezes. Win rate 65%. Swing on stocks, 1 to daily closes, blending with earnings catalysts. Options. Credit spreads capped at 1 delta neutral. The beauty, 1 adapts, doesn't dictate. Listener Q&A time, because you're not alone in the trenches. Q. What if my strategy's naturally on Estot wall? A. Hybrided. Core 1. Extension on Confluence Tier 2 e.g. MACD Bullcross. Q. 1-2 conservative for growth. A. Compounding's conservative magic. 10% monthly on $10, $31 in a year. 3 blow-ups. Back to square one. Q. How do I spot overstretch? A. If holds 3 days average, ratios creeping, tighten targets. Q. Psych tip for loss streaks? A. Walk away post 3 Ls. Review sim streaks. Variance, not verdict. As we near the finish line, we've covered ground. Remember, trading's not a casino sprint. It's a marathon with landmines. 3 lures with lottery dreams, but for retail reality, 1 delivers the steady stride. The video's wisdom, echoed in every survivor story. Balance beats bravado. Your edge isn't the ratio, it's wielding it without wobble. So, log off the hype, launch that audit, and trade tomorrow's open with one eyes. The market? It'll test you. But with this toolkit, you'll pass, not as a unicorn hunter, but as the consistent contender who compounds quiet wealth. Thanks for riding this episode. Drop your one wins in the comments. Next time, confluence without chaos. Until then, risk real, reward right, and keep the faith. Trade well.